Good afternoon, ladies and gentlemen. Thank you all for taking the time to join our webinar today. I'm Cam, your host for today's webcast, and we'll be unpacking a lot here today in this quarterly update. And before we do dive in, actually, we've got a lot to cover. There's a few housekeeping rule and compliance disclaimers for everybody. So this meeting is being recorded, and a copy will be made available on our YouTube channel afterwards, in addition to a copy of the slides. The format for today's session, the presentation will last approximately 30 minutes with a dedicated 15-minute Q&A session towards the end, and then sort of 15 minutes just for us to wrap up with our key takeaways, as well as changes to the strategy and how this affects you, the end viewers, and our clients. Before I dive in, there are a few disclaimers to go through just for compliance, so please bear with me as we get through this. So Dunhill Financial is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale and or purchase of any specific securities, investments, or investment strategies. Investments may involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and or tax professional before implementing any strategies discussed herein. Now, with that out of the way, let's dive right in and address the elephant in the room.
Cam, you forgot the most important disclosure. Just because our president invested in it doesn't mean it's a good investment, right?
Oh, we're just jumping right in.
We're jumping right in, right? Exactly. As I was
Isn't
about
that
to
the perfect
dive
transition from disclaimers right into the politics?
That is an excellent transition there, and I think we'll dive right in then in that case to address the elephant in the room, and it's a big one, as you mentioned there, Brian. It's politics. It's no surprise to anyone that's been reading the headlines or just watching the news. You know, Trump is now back in the White Office, and let's just say he has a bit of an interesting agenda for the next 4 years.
Well, let's back up a little bit because last year was a big political year.
Yeah,
Josh, we talked about that a few times, did we not?
Yeah, we had well in excess of 60 elections last year. Some almost a third of the world was all just voting for various different kinds of elections all around the globe. We started the year off with pretty interesting ones in Taiwan, etc. Finished the year with, well, the US, which I'm sure everybody is on this call is going to want to talk to that, and we'll get to that very shortly in due course. So this year, unsurprisingly, we're expecting, well, a smaller number. I mean, it's kind of an odd numbered year instead of an even numbered year. So most of us would expect fewer elections anyway. But after last year, we're looking at about 33 elections globally this year. It's roughly half of what we had last year. And then the big ones like the UK, France, the US are not in the picture. It's not to say there aren't some interesting things on the horizon. Now, about a month from now, for example, the Germans are heading to the polls. And that is significant from the vantage point of, well, right now, Germany has been going through a period where, so they have this in their constitution that they have what's called a debt break, basically. They have to maintain a certain debt to GDP ratio. They can't invest so much in infrastructure or spur growth like they're trying to do. So that's one of the things that's playing into this on the one hand, but at the same time.
Wait, let's back up there.
Sure.
Of the developed countries, how many other countries have a debt break on their amount of debt that they can have out there?
It's a great question. Do we know?
I don't think there are any.
I'm struggling to think of any that have something similar, if that's what you mean.
I think only Australia has a reduced amount of debt. It's not in that kind of near 100%. The rest of the world is significantly in debt.
It's a bit of a unique thing, especially in terms of the Eurozone. It does mean that they have that ratio. I mentioned the debt to GDP that's far lower than the Eurozone average, but it does kind of put them in a position where they're trying to spur growth that kind of handcuffs them a little bit. The new government might change that to a certain extent. Now, one big thing a lot of people know about Germany and bring up constantly, understandably, is the rise of groups like the AfD. And it's not so much that are they going to win the election or this, that, or the other, have more seats in the Bundestag. It's whether or not they do, it could be shifting the the political window in those types of ways. So that might be significant in Germany for that reason.
And the AfD is the far right group that
right.
has some Nazi sympathizer.
Yeah, there's a kind of an open question right now about how constitutional they are as a party. There's another factor to throw in there. That's why, you know, it's a little in question about whether or not they'd be able to actually stand as such. But it does mean that it's emblematic of the dilemma Germany's in, and as a result, what the prospects for growth in Europe are like. That kind of leads into the part for Cam. I'm not going to steal too much from him, I promise. He worked hard to come here and have that tie on. I don't want to take away a whole lot of your talking points. So that's really the main one that we're looking at right now is of interest. Now, last year being a huge one for global elections, naturally, a lot of the follow-on and the echoes from that are coming into this year. And I think there's one in particular that we'll definitely want to cover. But basically,
Well,
yep, go ahead.
Oh, so starting on the one that we want to cover.
Yeah.
We only have 1,458 days left of his presidency.
Not that we're counting.
We've
got a terabyte day calendar somewhere?
We've survived the first two. So now that is kind of in the front in the limelight. We've now got that first wave of executive actions from the president.
Mm-hmm.
What should we be looking for on the U.S. front?
Yeah, absolutely. Well, I think this is one of those cases where it's been a couple of days, so there's a lot of stories abound in the news cycle. It's really, I think, probably helpful you'll have what's on the front page, but you want to be thinking in more in economic terms about what to expect on a realistic standpoint. There's a lot of noise out there, and it's understandable that there's going to be a lot of commentary one way or the other. But the key is to remember what is something that really, from what we know from the first term, really drives Trump's mentality in those types of aspects. Brian, one guess as to what exactly he really wants to tie himself to, just from the vantage point of everything we know about his motivations and the way he sees his presidency.
I was thinking the long red tie the minute you said it. What does he want to tie himself
100%.
to?
Done. I was looking for the markets, basically.
I was going to go for the economy or the stock market.
Yeah. So basically, if the market does well, and even before he became president, he takes credit and says it's because of him. If it doesn't do well, it's because of Biden. That's not really new political fare to a certain extent. But what is a little different or feels a little different is, can either of you, Brian or Cam, tell me who was in the front row for his inauguration the other day? Do we remember who that was?
The oligarchs.
Yeah. Yeah.
Oh, I'm not supposed to use that word, am I?
I was expecting names, but I'll accept that too.
Well, we definitely had Jeff Bezos's, is it wife or girlfriend?
I think it's a fiance, if I
fiance, yeah. And Mark Zuckerberg was definitely next to them.
Yeah, that's right.
There's definitely the whole Magnificent Seven cohort there, minus
basically, yeah. So now
NVIDIA.
What I'm getting at here is, so you might be tempted to think well, this is a sign that the oligarchs will be involved in everything and that they're going to be looking for Trump to stay out of the way, et cetera, et cetera. There's a slightly different nuance to this as well, though. If we remember, the S&P was driven by the Mag 7 last year, and they did pretty well, right? Well, if we can think about Trump and Elon Musk, for example, and I apologize to bring them both up in such a loaded sentence like that. It's just when you look at how their relationship has worked out, and I'm sorry if this starts to feel like a reality show, but the point is, these are big egos. And these big egos have a propensity to clash at some point. So the idea being, yes, they might want to levy the government for some kind of leniency from a tax or regulatory vantage point, et cetera. But it also means there's potential volatility there. And they might feel like, well, they have more to lose from running afoul of Trump or for there being some kind of friction there. In other words, pairing that with how the S&P did, we might be looking for opportunities then to look wider in the market, not narrower up the cap space, basically. There's more to that story that Brian and Cam will get into in due course. Just to say, we're not looking to get too heavy on these. It's not us saying Mag 7 forever. There's more of a nuance to that idea.
So I think to tie everything there a little bit, if you don't mind me jumping in there, Josh.
Sure.
The takeaway that I got, and for our audience, is that, you know, there's a lot of policies in the pipeline. You know, some of them more rhetorical than anything else, you know, from the campaign. But really, it's something that we'll have to, you know, wait and see of whether it's, you know, purely a negotiating strategy and how many of these actually, you know, come into force.
Right. And one of the things that is somewhat idiosyncratic for Trump, rather, whereas with a Biden or an Obama, it might have been different. No, this is not a party thing. It's just the ego factor is something that you can't really discount, knowing how Trump operates. And it's just something we have to be aware of. And it's a different kind of presidency. I think we all know that. We just don't want to get too comfortable in what we've had before, because it's a different environment with a different kind of president is all it really means.
I guess that, sorry, you were going to say something there, Brian.
I was going to say, do we have any actual good news coming from DC as of late?
We do. I think we've got a little nugget here, and maybe if I move on to the next slide, and Josh, why don't you?
Yeah, absolutely. So those who are familiar with the windfall elimination provision have understandably been pretty much quite opposed to it. For those not familiar, real quick, those who have worked outside the US or haven't been contributing Social Security or contributing to a different system, you could have your Social Security reduced in retirement. This is something where, well, the good news is that has been repealed. So Biden signed one last bill that increases the Social Security for any American that was affected by that. And really, in other words, those who have worked abroad and contributed to other state pension systems, this is good news. It means that you don't have to do things like the calculation for how much you might be discounted. And if you do need to update your financial plan to take that into account, we highly recommend you do that. Reach out to your advisor if that applies to you. What you can also look into is that part of that bill is that you will be eligible for back payments going back to 24 as well. So it's also something to definitely keep in mind, is that it's not necessarily just going forward, but you can also be looking to claim some of that back if you had the WEP apply to you and reduce your income from last year. It doesn't go back further than that, but it still provides some very welcome relief for something that a lot of us understandably felt disadvantaged from because we spent time abroad. So
one less acronym for us to be talking about. That's the important part.
Yeah, all this alphabet soup feels like I'm back in the military.
And any new bills that we should be aware of going forward?
Yeah, actually, so this is something that people have been reaching out to us pretty regularly, because there's been some interest, because this isn't the first time that something like this has been put forward, to be clear. But the LaHood bill, for those aware or maybe not aware, I'll just kind of give you a quick rundown. This is an idea about trying to address citizenship-based taxation and opting for a different method or repealing it altogether. So people have been reaching out and asking us questions about it. Now, one thing to say is, like I said, it's not the first of its kind. These have been proposed before, and they've just never been ratified. Now, it's basically proposing an elective process for U.S. persons to be treated as residents abroad for tax purposes. Now, one thing that I think might be worth asking is, well, is this something that suits your overall plan? I understand the idea that many people are excited about this, but what's important to bear in mind is that you want to be balancing the prospect of not being taxed in the US with, well, if you're in a country like France, for example, there are some parts of that tax treaty that can benefit you really well and really serve to help your financial plan. Now, it's, of course, there's different cases for different countries, et cetera. But the point I would make is I would make sure you're reviewing your overall situation. And if you have questions, you know where to find me and us, for example. But there's things in there that are interesting. It currently has just one sponsor. That's why we have it listed here as the LaHood bill. But as is the standard with the things what we talk about, this is an early thing. You're free. You can write to your representatives to if you'd be interested in contributing to gaining traction here. But make sure that it really makes sense for where you live, what your overall situation is, and we can help talk you through that if you have any questions there. Any other thoughts on that I should cover, Brian or Cam?
I think the important part to talk about here is this is, first of all, just a bill. It will
On Capitol Hill. Sorry, had to finish that.
expire if it doesn't get signed, right?
Yeah.
And if Josh doesn't go into song, I will be disappointed when I say it's just a bill. Now, first of all, you can find lots of information across these different organizations. And on the American Citizens Abroad page, there is a great way to where you can actually figure out exactly how to contact your representative. If you are in support of this bill, it is important for them to get co-signers on there. But it is also important to get as many eyes on this as possible so that it doesn't have economic consequences to anybody that might live in a country like, for instance, France. Our good friend Jonathan Hadida, he's coined that double taxation treaty as the bee's knees, right? And what we don't want to see is Americans living in France being taxed in France instead of the United States because of the unintended consequence of a new bill. It also works in a lot of other high tax jurisdictions that they might be able to double dip on, say, being able to contribute to IRAs, all while contributing to some home-based plans. So we'd want to make sure that it doesn't exclude things from double taxation treaties that people are able to keep, and that it's reviewed appropriately in those manners. So
basically, for as much as we howl about life as a U.S. expat, we tend to forget there are really nice things about some of these different aspects where we can benefit from both. So just don't throw the baby out with the bathwater here, and just make sure it makes sense for your situation. It's the general idea.
Everything makes sense in the situation because nothing has changed. It's just if the bill starts to move forward.
Absolutely.
But get more information. Come to me. I definitely have plenty of information on this bill and plenty of opinions on this and just about everything else, as Josh and Cam probably figured out in the last couple of days as we discussed this. But how does this affect our overall economy, Cam? What should we be looking at in the next year?
Absolutely, and thank you, Josh, for that deep dive on the political landscape, as well as some of the bills that have been approved, and some of the ones which are still just on Capitol Hill. But no, it's an excellent point you bring up, Brian, which is with some of these policies in the backdrop, what can we expect from the global economy here going forward? And one of those aspects is really the GDP. 2024 has been an interesting year. So the question I think on everybody's mind, including our clients, is what does 2025 hold? So why don't we unpack what's going on here in this chart, first of all, for our audience, and how this relates to positioning in the portfolios, which we'll tackle a little later.
It's a very nice, interesting, concise bar to look at. We'll ignore Japan. Not because that's not significant and such, but more because that's probably more of a side trading aspect of things rather than things that are going to move the world in a big way. But over on that right-hand side, those are the numbers that are going to really affect the global GDP numbers, the US and China. There's an expression that we overquote, which is when the US sneezes, the world gets a cold. And we can see US GDP 2024 much higher than what we expect in 2025. So a slowdown over there. And China, who was for years expected to be the growth engine, the next growth engine of the world, having continued shrinkage, probably not helped by having a US president that's so anti-China. But the US has one big reason that's amplified in the last couple of months. We've been talking about 14, 15-year period, I think, at this point in time. Would that be about right, Cam?
Mm-hmm.
That the US dollar has been going up compared to global currencies. And right now, what's really happening is that it's getting amplified. And a lot of that amplification is because of those 7 policies that Trump has put forward that most economists are estimating could be inflationary. As a reminder, if inflation goes up, our central banks have no option to curb inflation in any other way than to raise interest rates. The higher interest rates go up, technically, the more attractive that currency becomes through investment until it becomes emerging market territory where it's too high and then it causes reverberation. But for developed markets, higher interest rates become stronger currencies. And that's exactly what we've seen. We don't have high inflation right now in the US. We have the fear of inflation. And so that's led to a much, much stronger dollar. This is just the graph since the election,
Yep.
right? So this is a very, very short period of time. I think it was a little flatter over the course of the year before the election, and then we've had this nice little ramp up. But have we had any other historic seen this much of an increase in inflation, Cam? Oh, I'm sorry, this much of an increase in the dollar?
I think it's if we take a step back and look at the bigger picture. So if we look at the dollar on, not just since the election there, as you pointed out, Brian, which again, it's, if we look at the broad basket, so just for our audience here, we're not looking at the dollar against a specific currency like the euro or the, pound or anything. This is looking at it from a broad basket, which really isolates, the strength of the dollar versus just weakness in one, although they're 2 sides of the same coin there. But essentially, since the election, the dollar has strengthened, close to 5 to 6% from that basis against the broad basket. But if we zoom out and look at it from a bigger context there, the dollar is expensive. Is it as expensive as it's been in in the past in certain stages? Not necessarily, but we're getting close. We're getting close to those territories. And I think one of the most notable points was just before the Plaza Accord, which was in 1985, which we'll get to a little later. And the reason we point out that particular moment in time is because it ties in quite nicely with some of the policies here, Brian, that you were mentioning, that Trump would like to enact. And one of them, and he's been
First of all, let's point out that arrow right there in 1985. So we've got the time as the x-axis and the price of the dollar and the y-axis. So right there in 1985, that's where we had that huge spike up in the US dollar. And before we get to really the Plaza Accord, what led to the Plaza Accord?
That's an excellent question. I think predominantly the main factors was, after the end of the Second World War, the dollar was, just attracting safe haven capital from that perspective, which,
there's 40 years in between there, Cam. There's 40 years in between. In the late 70s, you got to remember we had extremely high inflation, right? And Volcker increased interest rates to curb that inflation, and that attracted huge flows into the US dollar. So essentially, that was that time period. And what have we had? We've had quite a bit of inflation the last few years. It's curbed, but then we have a president that might be, like we said, there's not inflation right now, but there's the fear of inflation, which is increasing the dollar. Nowhere close to that spike that we had back there. But essentially, Cam, you said 5-6% in a few months?
Correct, yeah.
That feels like a lot. Not as much back at there in the early 80s, but a lot. So when we start to unlock the Plaza Accords, we go to the next slide, Cam. What our fear would be is that essentially all of this posturing for new tariffs or new structures is really just a means for the Trump administration to potentially put together, as Cam put it, the Mar-a-Lago Accords, i.e., try to force down the US dollar by having negotiations with all those countries that are benefiting from weaker currencies right now. The Trump administration, well, Josh astutely pointed out, marks themselves as essentially stock market proponents and the victors of the stock market. Trump even rang the bell. And I think that's the perfect view of him as a president. He thinks whatever the stock market is doing is representative of his actions. And the easiest way, going back to that original GDP view of increasing your GDP, is by decreasing your currency. So while we're not saying this is definitely going to happen, we're saying we need to be vigilant of it. For hyperinflation to go into place, or at least going into high inflation, that would impact GDP much further by increasing interest rates. And that's not exactly what Trump wants to get into place, because this is the view that he wants everybody to represent and have of him. So these are the things that we're really identifying as our biggest concerns of a big renegotiation like we had back in 1985. And we'll go into how we want to identify that in our overall portfolios. But that being said, inflation up, inflation down, the stock market has correlations, but it's not all caused by those. So what does the stock market look like right now, Kim?
That's an excellent point. I think that segues nicely onto our next slide here, which is I'll just unpack this here for our audience, and then Brian, you and I can maybe have a more deeper discussion of where we sit when it comes to valuations here, and why it's not necessarily something to be crying over the hills over for, but something to be mindful of. So for our audience here, we're just looking at the concentration in the S&P 500 index to the top 10 names. If you've been paying attention to any of the headlines, regardless of which mainstream media news that you look at, there's all sorts of acronyms being thrown around, whether it's the Magnificent Seven or more recently the Batman stocks, I think is what Brian coined in his most recent newsletter. It's no surprise that concentration in the top 10 names has increased. Here we're looking at on this slide, if we look back to the S&P 500 from the .com to 08 till now, we haven't seen concentration this heavy.
You're in the upper right quadrant of the percentage.
Yeah, the upper right quadrant here. Maybe I can annotate on my screen, but let's not.
So if we took the S&P 500, currently nearly 40% of the S&P 500 is made up of 10 names.
That sounds like a lot.
Historically, it'd be sitting kind of in the 16 to 25% range. Now, Kim, you've identified that our portfolio is at 25%.
Correct. Yeah. So as you pointed out there, Brian, right now we're sitting at close to 40% concentration when it comes to the S&P 500. But for most of our clients, when we look at our portfolios, our Magnificent Seven exposure is closer to 25% across the board. Again, depending on which risk level you're sitting at.
Now, Josh astutely pointed out in the intro with the political background, one of the major risks of this Trump administration, which is they're very close to a lot of those bosses or founders of the Magnificent Seven. We have Amazon, Jeff Bezos was right there. at the inauguration. They're funding $40 million for Melania's movie, right? Elon Musk, well, he funded what, a quarter of the election, the campaign, and well, a lot of hotel bills at Mar-a-Lago. We can go down the list, but even some of the old age opponents like Mark Zuckerberg paid significantly for that nice indoor inauguration that we had. So essentially, they've all gotten very close with Donald Trump. And Josh, how did you characterize Trump's clash of egos? Was it?
Well, basically, didn't it feel like Elon Musk was kind of becoming a overstaying guest at one point, and it just seems like this is a natural consequence. These are big personalities, and that's, you can argue that's part of how they're in the position they're in. But what it also means is, well, are they all going to play nice? That's not exactly a closed question, is it?
Well, if you take a company like Tesla, right?
Mm-hmm.
If Tesla were valued at the same price as General Motors, do you know what would happen to that stock? It would drop 90%.
Yeah, probably nothing good.
90%. Now, it's definitely worth more than General Motors from a valuation vantage point, because there are different aspects to it that spin off more revenue than a General Motors. But that's to say, there's a lot of room on the downside that could be had in some of these. And what's happening is the S&P 500 doesn't have that same level of diversification that we had in the past by having 500 stocks that are balanced, when 10 stocks, sorry, make up 40% of it. Right? So this is why we keep identifying one of our biggest fears of the market is that these 10 stocks don't continue to be the driving force of the stock market. And that would have a bigger impact on many portfolios. Warren Buffett, for a long time, said, if I didn't run Berkshire Hathaway and have all my wealth in here, I'd put 90% of my money in the S&P 500 and 10% in 10-year treasury bills. Well, he dumped his Apple stake not too long ago. So it speaks to his view of what the S&P 500 looks like right now. So this is why you're seeing us reduce that Magnificent Seven exposure, or those top 10 exposures, below what the market rate is, because essentially any position that we put in our portfolio should have 2 times the upside, at least, to 1 time the downside risk. And a lot of these Mag 7 seem to have just as much downside as they do upside. It's not a prediction. That's not us saying they will fall apart. But if we can find things that are correlated with these areas, then essentially we can reduce some of that big risk if we have a clash of egos that ends up having a detrimental viewpoint on some of these companies that have built up natural monopolies in the economy.
I think that's an excellent point you bring up there, Brian. If we just switch over to another slide here, just to stick to that point there. As you mentioned, the concentration in the top handful of names, the biggest fear is what happens when they're no longer magnificent and they're just a regular 7 cohort. And again, going back to your point there, I think the other parts of the index, or the other 493 or 490, if you're looking at the top 10, they have performed somewhat, but not to that same extent as those tech companies there. So would it be fair to say that heading into this year, we could see some actual positive growth from the other 493, to potentially make up for it? And what does that actually mean for, I guess, our clients' portfolios when it comes to actions we're taking or potentially looking at?
Well, we've had 2 amazing years in a row. And essentially going into this new year, I believe there's 70 companies on the S&P 500 that the analysts expect over 20% earnings growth, right? So how much profit they're making growing by 20%. When there's 70 companies in there that have that potential of growth, there's a lot of potential upside. But what we're trying to do is we're trying to not limit ourselves just to the S&P 500. You've seen us purchasing more small caps or more concentrated areas that are essentially taking part in the growth of, say, AI or EVs or such, without just investing in the AI company or EV companies. But small cap companies have a much lower price to earnings ratio. So if you go back to the last slide, Kim, over on the left-hand side of your screen, what you're really seeing is the price to earnings ratios. I'm assuming those are forward PE ratios. Right, Kim?
Yeah.
So forward PE ratios of the top 10 are essentially currently nearly at 30. Now, I believe the S&P 500, well, actually, no, I'm sorry, there you go. The average is at 20.6, right next to it. So when we really look at a historical average P ratio of 16.6, so 17, call it, and those top 10 are nearly double that, they're pretty much priced to perfection. So that's not us saying these are bad companies or something bad's going to happen to them or anything else. It's just saying the best way to invest in the stock market is through diversification. We're losing that diversification because they're becoming such a big part. And if those are priced to perfection, they have a long way to fall just to become an average S&P 500 company. From 30 to 15, that's a 50% drop. Gave the example with Tesla, etc. So it's finding ways to get that upper exposure, buying cheaper areas, small caps, potentially even going into the currency play of buying internationals at some point going forward. And trying to make sure that we have just as much upside, 2 times the upside to 1 times the downside, instead of a potential 50% downside risk if something detrimental happens to them.
So, go ahead.
Sorry, go ahead, Kim.
No, I was just going to say, I'm just doing a quick time check here. Want to make sure we have plenty of time for our Q&A section. So we'll sort of round things up here. And as you pointed out, Brian, with some of those points that you raised, what we're really trying to do here is delineate the forest from the trees, right? As you mentioned, the 2 biggest things that we're looking out for right now is, as you mentioned, the inflationary aspect, which is not an issue right now, but it could potentially cause some concern later on down the line, depending on how those policies play out. But more importantly, I think the bigger aspect there is definitely that currency, as you mentioned, and those are some of the 2 key aspects that we're really keeping an eye on. And when it comes to the actual updates to our clients' portfolios, as you said, it's really identifying that concentration risk in some of those select few names, and looking at other ways where we can get similar exposure or participate in some of those themes, whether it's AI or some of the data centers, but not necessarily be tied to those handful of names there. So that's
in past years we used to talk about how the government was going to one day break up the Mag 7, or back then it wasn't even the Mag 7 just yet, but break up your Googles and your Apples, your Amazons, because they were starting to turn into oligopolies and potentially monopolies in certain areas. Ironically, Peter Thiel writes his book calling it From Zero to One, which is basically the definition of a monopoly. gosh, how easy this world would be of investing if all those were broken up into several companies.
Yeah, I think it's definitely a conversation you and I have had at length and ad nauseum, but I think it is one of those aspects where, you know, some of those companies, if broken up, there's real value to be unlocked, and it gives investors a lot more optionality as well. You know, in this particular administration, when you have the billionaires all lined up on row one, as Josh was pointing out at the inauguration, is that a likelihood? Maybe not. We'll have to see. But I think from an
And even
investor
more so,
perspective,
the regulator of the world, the European Union, they're all on their back foot right now because they have Trump attacking them. So are they going to really attack U.S. companies? What was it? The front page of the Financial Times this morning. Threat to double rates on foreign citizens of business from a 90-year-old law. It works if I put it on my chest. Reflecting newspapers in hand. Reflecting on a 90-year-old law that they could actually discriminate against companies and tax them double to go ahead and go against foreign countries and what they feel is done in ill will towards them. That puts the European Union completely on their back foot about going against these and trying to divide them up or trying to find them, because essentially Trump has already shown his card of exactly how he's going to attack them. So we are probably stuck with them not getting broken up or not being talked about for the next 4 years, as Cam astutely points out there. So it's finding those side ways of going about it, and being able to find some gems that are out there, but also looking out for the potential problems that might come up. We need to be ready to be able to switch to a more globally viewable portfolio. Well, why are we not buying European fixed income right now? Well, simple. Not only do we have an appreciating dollar, which will continue because of the higher interest rates, but you're going to earn less interest if you're in the European bond versus the US bond. But if all of a sudden Mar-a-Lago Accords, as Cam dubbed it, comes into place, we'll be ready to make those switches very quick, and we'll be ready to put those into place. We might also see, from a sector basis, like I said, some introductions of some more non-US centric allocations. We've been very US centric in the last few years, which has been very beneficial for our portfolio. But at the same time, it's starting to look like that time might be an opportunity to get on the other places. I don't think that's going to go down the lines of emerging markets just yet. And I always hope I'm going to be wrong with the emerging markets. You know, India's done very well the last couple of years. I love that. But with, what is it? 3 of the Mag 7's biggest markets are in India.
Yep, that is correct. And
I would love
also...
for India. I love to miss the boat on India, because it just looks like too much risk at too high of a price. But we love to see it continue to grow because it helps all those US companies.
Absolutely, that's an excellent point there. We're just going to land the plane here now and open it up to our Q&A section here. So again, there's the chat functionality here, so you'll be able to type your questions in there, and we'll give the audience a couple of minutes here to get their thoughts and questions through here. In the meantime,
so I got a question for you, Cam, while we wait for those chats. If you go back to that GDP chart, you will notice that UK actually is looking like an increase. It seemed like a very interesting time period since Rachel Reeves' budget. There's been a lot of speculation in the press about different items. Well, what do you think is leading towards a potential GDP growth in the UK?
I think that's an interesting point. I think part of it is just coming off an absolute low base, right? Because let's be real, the UK economy hasn't really done so great in the last year or so. But the most important aspect, I think, is the currency. You know, if we look at the pound, it's been absolutely hemorrhaging for, you know, it depends how far back you go. You could almost make the argument that it's been hemorrhaging for almost 200 years. It's declined in real purchasing value for 200 years straight. But in a more modern context, you know, the last 3 years have been absolutely brutal. If you know you've got assets in the UK, but for many of our clients, you know, where most of their assets are, you know, stateside in dollars, it's been quite a boon. But I think as we're starting to see some of that normalize, you know, by this new government potentially looking to borrow a little bit more than they collect in tax receipts to stimulate some form of growth, anything at this point, really. You know, that's probably what's leading to some of this forecast for 2025 being slightly more rosier than 2024. But again, to put it into perspective, we're talking about just under 1% to just about 1.5%. Now, you know, is that something to celebrate? I think if you ask the typical Brit on the street, I think they'd take anything at this point. So that's my 2 cents on the topic, though.
A victory is a victory at the end of the day,
A
right?
victory is a victory, as the British would say. And I think Europe actually, to some extent, is a similar story. What are your thoughts there, Brian, on Europe? I mean, again, we're looking at very marginal gains there in 2025. Would you say it's a similar story to the UK, where they're coming off a low base, or is there something more structural there in Europe?
The more debt you take on, I mean, naturally, all but Germany are basically enhancing their debt, and government spending is a big part of GDP. So essentially, I think government spending right now makes up 22% of the US's GDP. I don't know the figure for Europe. But when 1/5 of it is made up of government spending, if you increase government spending through debt, and debt is extremely cheap to get, you can actually produce GDP in a quite simplified way. So I see that as spending in that regard, but it's still too low of growth to try to dig themselves out of that problem. The problem that I don't know if you saw this. There was a report this morning that I think it was for the quarter. Don't quote me on this. Inheritance tax in the UK went up to over the 6 billion mark for the first time, and it increased by 0.6 billion because of the baby boomers starting to pass away. Those are going to really start to increase significantly come 2030. And that could actually become a much bigger part of a lot of Eurozone budgets and the UK budget because the inheritance tax thresholds are so low, and the baby boomers are going to be getting to that age where they'll start becoming a smaller part of our population instead of a bigger part of our population, and those costs will no longer be part of that. So it could be that first phase up as well. That will help from a debt vantage point.
We've got an interesting
Angela
question
has
here from Angela. How do you think the US will reconcile putting tariffs on EU and China products while simultaneously depreciating the US dollar? Or do you see these issues as more sequential?
I think that Trump is posturing on most of this. Or when I say I think, I hope that he's posturing on this from the vantage point that the tariffs will actually hurt the United States, not as much as the countries that he's putting the tariffs on, but it will hurt them because it will lead to some inflation. I love this chart that Cam pulled up because it gives you kind of a 100-year view of what tariffs were like in the past, what percentage they were in the past versus what they are now. So when we go back 100 years ago, Cam, we decided that 1933 was when
33.
Hitler came into power, with the Great Depression being 1929 to 1939.
Yep,
Um,
we're not saying there's a correlation there, but you know,
we're just giving points in time, Cam. We're just giving points in time, you
I
know?
mean, tariffs definitely did peak, you know, right around the Great Depression era, and as you mentioned, the rise of you know, some questionable leaders on that side. But you know, at the end of the day, tariffs really, what are they designed to do? They're designed to cause more friction in global trade. And I think if we look at the past, you know, if we go way past 100 years and go into historical context, most wars have, you know, come about on disagreements in trade. So maybe there's something to be looked at there. But it is an interesting slide where, you know, the last 100 years, tariffs have done nothing but go down in a linear fashion. And you know,
And
are we
growth has
entering?
gone up.
And growth has gone up, right?
It's
I
gone
don't think
up.
there's
So
anybody
that's
saying
why I try to make that parallel, is that's
mm,
when we were at the highest tariffs,
mm,
was on those historical occasions. And I don't think any of us want to get back to those levels. Like you say, wars come about from trade friction. And you can see what that proposal has us getting back to from this great JP Morgan chart, which is almost those levels of the Great Depression and Hitler coming into power.
So essentially, what you're saying, to tie it back to the start, is that the idea, maybe I can dare to say hope, is that it's a bargaining technique or negotiating more than an actual hard threat.
I would hope so, because anything else to put it in place would put in higher inflation, which would mean a stronger dollar, which opposes him being the stock market's president, right?
Mm-hmm.
So it would be a foolish move for what he's trying to accomplish, which is a lot of short-termism.
So it's one part could be negotiating technique, and the other part, it sounds like the suggestion is it could also be political theater potentially. But am I reading too much into this?
It could be
Yeah.
in that vantage point. Um, what I'm saying is, yeah, we need to watch what they're doing, not listen to what they're
Right.
saying.
Yeah.
What they're saying a lot of times is ridiculous, just from the vantage point of distraction or hyperbole.
Mm-hmm. Exactly.
I don't think we have any other questions here. We'll give it another minute or so, but in the meantime, I want to thank our excellent panelists here, Josh and Brian, for their insightful thoughts, especially on the political spectrum, but also tying it back into, you know, how this affects the wider economy, the markets, and then potentially client portfolios going forward. As mentioned, a recording will be available on our YouTube channel shortly, so you'll be getting a link to go through that in your own time or share it with friends and family, etc. We'll also be sending out a copy of the slides as well for a number of the topics that we weren't able to cover in depth here in today's session. But as always, thank you very much for joining us here. We hope you found this insightful. And if anybody does have questions later on, feel free to get in touch with us via email. And again, once again, thank you to both Brian and Josh for today's excellent webcast.
Thanks so much, Cam. Thanks, everybody.
Sounds perfect. Thank you both. Have a nice day.